Let's go ahead and get started. Does everyone have a packet with the slides and such? All right, great. Well, thank you for coming on our holiday. Sorry we didn't have Columbus Day off. We're up to me. We definitely have all the holidays off. I'm going to start with a quick review of the material from last week. I feel like that was a bit dense and may have lost a couple of you as I went through that material. But rest assured, we'll do a quick review, and I think when you see these concepts, you'll say, oh, I took the important things away from that lesson. And of course, if you have any questions, we can go over those quickly. Last week, we talked about this idea of the capital asset pricing model being a way of determining the cost of equity capital. And we said how risky is this company, how variant are the returns, and the more variant, the more risky we determine that company to be. And the folks who developed this capital asset pricing model came up with a security market line which measured the cost of this capital in two parts. And we've talked about this all quarter. One is just the time value of money. If this money were risk-free, what would we charge for it? Just because we don't have the money now. So this required return on an individual asset I is going to have these two parts. One is just the risk-free rate, time value of money. The other is the risk associated with these cash flows. We don't have them yet. A lot of things could happen between now and 10 years, now and 20 years. When you say I'm going to get all that money, so I'm going to add a risk premium. We start with a risk premium which is generalized to the market. How much is the average stock in the market? How risky is that? There are various services which will give us an estimate, which we'll talk about later when we put this together with other costs of capital. So we might say the risk premium in the market, in addition to the risk-free rate, is 7% on top of that. So that might be the metric we would use. In addition to that, we have this term we call beta, which tells us how risky this particular stock is compared to that average risk in the market. So the required return for the individual asset, risk-free rate, plus the market premium compared to how risky that stock is to the overall market. Now this beta figure, remember there's a couple components that come into that, and the higher it is, the higher this cost of capital figure is going to be. Beta is determined by the correlation of this asset to the overall movement in the market. And we talked about this correlation figure, this funny looking P, being a way to determine how synchronized the market is with this particular stock. It could be in perfect lockstep, and it would have a correlation coefficient of 1, which would be the highest correlation coefficient it would have, and that would have the effect of making this beta figure higher, and ultimately making the required return higher. It could have a beta of -1, where the market and this individual stock move in perfect opposition. And that's what we liked as a portfolio manager, looking at this with portfolio manager's eyes, saying that if we could have stocks that essentially canceled each other out, when one company was having a bad year, another company would be having a better year, and that would smooth out our returns. And those lower betas would require a lower cost of capital. The other thing that goes into this beta figure is the overall risk compared to this individual stock, or this overall risk with the stock, divided by the overall risk in the market. So they might be moving in perfect lockstep with a correlation coefficient of 1, but this individual stock might be 4 times as volatile. So the stock market goes up a little bit, the individual stock goes up in perfect, reflective, whatever you want to call it, but it's more volatile. The more this stock is volatile compared to the market, again, the higher the beta is going to be. So this is the key takeaway from our material last week. This cost of equity capital has the two components, risk-free rate, market premium, and beta figures into that market premium for this individual stock. How are you all feeling on that? Seems to make sense. Feel good? Questions on it? Yes, so the beta has these components in it. So the correlation coefficient is multiplied by the risk of the individual stock, or this is standard deviation of the individual stock, which we'll just call risk, divided by the risk of the market. So suppose this risk of the individual stock is 3 times more than the risk of the individual market. This number is going to be 3, right? And then we multiply that by the beta, or the correlation coefficient, which is maybe 0.5. So that's going to be 1.5 for the beta. Now suppose this individual stock is less volatile than the market. Suppose the individual stock's standard deviation is 0.7, and suppose the market's standard deviation is 1. So we're going to have 0.7 for this figure, and then suppose the correlation coefficient is the same, 0.5. What's 0.7 times 0.5? That's 0.35. So we're going to have a beta of 0.35, and that's going to be lower than the example I just used of a beta of 1.5. So we've got 3.5 here is going to translate into a lower cost of capital. So this is a stock that is not as volatile compared to the market, so the premium we're going to charge discount those cash flows is going to be lower. Does that make sense? Now we talked about the efficient market hypothesis a little bit towards the end of class, and I don't feel like I explained that too well. Hopefully I at least gave you a little bit of a sense of that, combined with the fact I don't know if I explained it effectively. It was at the end of a long evening, so we'll just say you've been exposed to it a little bit for now. If you have any questions, I can definitely answer them. Talk further about the efficient market hypothesis, but we'll just say we've talked about that and move on from now and not ever come back to it with the quizzes or the exam or anything. So I guess I wanted to continue reviewing this. So with this beta, we talked about the security market line. We used an example of suppose we have a risk-free rate of 4%. We would charge on any investment, whether it was risky or not, and then the higher the beta is not necessarily a bad thing if a stock has a really high beta. It just means we want to understand that it's more risky, and we want to be compensated for that. So the higher the beta, the higher our required rate of return, and the higher our required rate of return, once we do the cash flow analyses with this company, that's going to make the value lower or higher. If we have a higher required rate of return because this company has a higher beta, what's going to happen to the value of that company in our eyes? Frida? Would decrease, right? So the higher required return, that value figure is going to go down. We also talked about this idea of comparing performances of different portfolios. And we used an example of this portfolio, JJ, had a certain beta and a certain return. This portfolio of CC had a certain beta and a certain return. And we can see that the CC return is a little bit higher than the JJ return. So the CC fund manager says, yay, look at me, I had a higher return last year than this person. Why do we disagree with that portfolio manager's assessment of she or he outperforming JJ?
CC is more risky?
Yes, CC is taking more risk. So we would hope that CC has a higher return to compensate us for investing in that portfolio, which contains, by this beta metric, more risk. Make sense? All right, so we'll move on to today's lecture, which is continuing on this cost of equity capital and adding in some other components. We'll talk about the cost of debt, we'll talk about the cost of preferred stock in the various components, and then we'll put all those together in a formula we call the weighted average cost of capital, or WACC. We'll think about the factors that affect WACC, and of course, as we always do, think about the risk underlying that pulls those levers and makes the various WACC metrics higher or lower. Bringing us back to our graph that we've talked about throughout the quarter. Our goal in corporate finance so often is to find value of something. Maybe the value of a company, maybe value of your personal investment. Maybe your manager comes to you and says, hey, look at this oil deal. Do you think we should invest in it? Here's the financials, here's the comparables, here's the things you should consider. Your job would be to come up with some sort of value. We know the basics of time value of money. We know how to pick apart financial statements and come up with a free cash flow. We've talked about market risk, risk aversion. We've talked about some firms' business risk assessment tools by looking at financial statements. Today we're going to put it all together. We know a little bit already with the capital asset pricing model of the cost of equity. You pretty much know the cost of debt, but I'm just going to remind you a few things about that. And we're going to wrap it all up with our weighted average cost of capital, which is going to be everything. Everything we need to complete this value statement. We know how to get the free cash flow figure from financial statements. Now we know how to calculate the WACC. We know how to do time value of money. Boom. We're off and running. On to Wall Street after this class. Types of capital. We'll look at these three. Long-term debt. How much do we need to return to the debt holders? What's the cost of that? Preferred stock and common equity. We'll put those three things into the weighted average cost of capital formula. Quick discussion, comment on before versus after taxes. When companies take out a loan from a bank, they pay interest. Additionally, when companies sell or give shares to shareholders, they sometimes pay dividends. So we've got interest payments and we've got dividend payments. One of those two is tax deductible. Does anyone know which one it is? Interest is tax deductible. So if you take out a loan, you're paying interest to the banks, and you have a benefit from that interest. So that is going to make your cost of debt lower. So if you're paying, say, 8% interest, but every interest payment you make decreases your tax bill a little bit, you might do some calculations and say, well, yes, I pay 8% interest to the bank, but because of the tax benefit, it's only like I'm paying 6.5% interest. So debt will have that advantage. We'll see how to work that out. Dividends are not tax deductible, so we do not do that calculation. We're going to figure out the after-tax cost of debt. Only debt is affected. Which brings us to cost of debt. How do we figure out how much a company has to pay for debt? So you are one of the managers of the company, or you're looking at one of the managers considering whether you want to invest. How would you determine how much you're going to need to pay your debt holders to get a loan? What would be the ways you might go about that? Feel free to look at the slide if you want, but you could also just use your intuition and tell me, all right, I'm a manager of a company. I need money for my company. How much is it going to cost me if I take out a loan? What's the interest rate I'm going to pay? How would you determine that? A couple of ways. You might go to an investment banker and say, this is how risky our company is. These are the financial statements. What's the market like? What are debt investors willing to lend at? And I hope one day you all, one of you all, or some of you all, might be that investment banker who says, let me do those calculations for you and tell you how much interest you might have to pay. We'll come up with a cost of debt that way. Another way, has anyone heard of bond ratings? AAA, single A, B+, C. Anyone heard of those? Yeah, a little bit? Okay. Does anyone remember a few years ago when we had a government shutdown and I think the U.S. government bonds got decreased in bond rating? We went from AAA to, in at least one of the agencies, they said the United States government bonds are no longer a rock-solid investment. They're one notch below. So if people want to lend us money, they look at that and say, I'm going to charge you a little bit higher interest rate because your credit rating is no longer top-notch. So we might do that with our company, or this company, we're trying to evaluate how much debt there is. Say, all right, this is the kind of strength of the company based on our analysis. They are a B+ rated bond. And the current interest rates on B+ rated bonds are about 9.5%. Might be something that you would do. What else? Find the yield on the company's debt. So if a company already has some loans, then there might be a yield on that interest. You can find that by some investigation into the financial statements. And you'll see that the company already took out a loan with Bank of America for $50 million, and the interest rate on that is 6%. Now, there's a nuance about the interest rate that they are paying and the current yield that you might consider a company has on debt. What would happen is the company might take out a loan from Bank of America for $50 million and be paying 7%. But that might have been 3 or 4 years ago. And a lot might have happened over the last 3 or 4 years. That company could have gotten into a business that made them more stable, and they could be seen as less risky. The company could be going through some turmoil, and they might be in danger. And people are looking at those loan payments, or looking at those little coupons that say, we promise to pay you 7%, and saying, well, it's not worth as much. I want to be paid 9% if I'm going to buy that piece of paper that says this company owes you money. So these notes change hands, and the yield can change. Does that make sense? So the amount of the interest you're paying initially might change as things change with the company. So we want to use what we'll call the yield rather than the coupon rate. It's really just for your edification. You won't be tested on that specifically in this class, but good to keep in mind. Yeah, we don't use the existing coupon rate. We think of the past yields, unless there's a current, unless there was a loan made very recently and nothing has changed since then. Then we could look at the current coupon rate. All right, so this is going to bring us to our example. Let's assume there's a tax rate this company faces of 40%, and there's a before-cost tax of debt, 10%. So they took out a loan and said, we will pay you 10% interest payments on this debt. It's going to be our starting point. However, this 10% is tax deductible, so we're going to do a calculation which is going to change that 10% slightly. Now, is this calculation going to make that 10% cost of capital a little higher or a little lower? Absolutely, it's going to make it a little bit lower. This is how we'll do that calculation. We take the after-tax cost of debt is equal to the before-cost tax of debt, which is 10%, and we multiply that 1 minus the tax rate. 1 minus the amount we still need to pay. And in this example, it's going to give us 10% times 1 minus the 40% tax rate. Our after-tax cost of debt is going to be 6%. It could be a fairly significant difference. So this is the first big piece of our work tonight, is this formula, the after-tax cost of debt. How we take the before cost of debt times 1 minus the tax rate. It's one of 3 key pillars for tonight's weighted average cost of capital. Flotation costs. Flotation costs for debt are apparently small. Before we even say they're small, let me ask you, does anyone know what flotation costs are? Flotation costs are costs of underwriting the loan. Investment banker takes a little cut. The brokers who handle the trades and whatnot may take a little cut. So while we're paying 10%, we might have to pay a little bit more if those flotation costs are higher. But apparently, flotation costs for debt are something we won't worry about too much. We will worry about flotation costs for some other things, however. So that's the cost of debt. We're going to move on to the second component, cost of preferred stock. Now, what is preferred stock? All right, somebody help me out. Preferred stock. I know someone's heard of it before. No one? Okay, so preferred stock is a type of stock. It's different than common equity, because owners of preferred stock do not have voting rights. But owners of preferred stock have preferential treatment in the event of bankruptcy. So if the company goes bankrupt, a number of things would happen.
They can't
But-
claim this property, this stock.
What's that?
The bank can't claim this stock, preferred stock.
Well, yeah, a bank could buy preferred stock. Bank, I just gave the example. Bank of America gave us a loan. They could also give us $10 million for preferred stock. Now, in the event of a bankruptcy, the debt holders are first in line. The preferred stockholders are second in line, and the common equity holders are last in line. So our company goes out of business, but we still have a building, we still have a bunch of inventory. The bankers who gave us this loan come to us and say, that building is ours. If there's anything left, preferred stock owners get it. And in the event there's anything left after that, the common equity holders get it. So preferred stock, it's a little bit safer, I suppose, because they're in line before the common equity holders. But this idea of this concept of them not being able to vote on company policy does play a role in the people who buy preferred stock versus common equity. So they're going to be preferred stockholders just want their dividend. They don't want to be active in the decisions of this company as much. So higher claim in the event of bankruptcy. They don't have voting rights. Generally pays a fixed dividend. So if someone invests or buys preferred stock from us, say they give us $100, and we have a fixed dividend that we're going to pay them, say 6%. Every year we pay them $6. And it's often important for companies to pay that dividend consistently. We'll talk about this later in the quarter, that if a company shifts that dividend policy, the market can look at that very unfavorably. Say, what's going on with this management? This company just must be going into a tailspin because they always pay preferred dividends, but this year they didn't. So a company will very often try to pay a consistent dividend. So, suppose we are that company. We sold shares of preferred stock for $100. We're paying a 6% dividend. Just based on that information so far, what would you say is the cost of capital for preferred stock? Someone said something? I heard something. I swear to God, I heard something. It wasn't just me. So we sold shares, preferred stock, for $100. Danelle gave me $100 and said, invest it wisely in your company. I said, okay, here's a little piece of paper that says you own $100 of preferred stock. Every year I give her $6 in cash, and she still has this piece of paper that says she owns $100 of my company. So what is the cost of capital of the money Danelle gave me? It's a number I'm looking for. It's like 1%. This is from 0% to 100%. Just like we calculated earlier, the cost of debt was 6%. Right, that's one pillar of the weighted average cost of capital. Now we're on to step 2 of the weighted average cost of capital. I'm paying Danelle $6 on $100 every year. 6%, right? Okay. I've been worried there for a minute. So 6% is the cost of capital based on that information. And you're pretty much there for figuring out the cost of capital for preferred stock. There's 2 little kinks that we need to consider. One, suppose flotation costs, the banker fees and whatnot for preferred stock are high. And I need to calculate that. So Danelle gave me, or my banker Carlos, $100, and I gave Carlos to give to her a piece of paper that says you have $100 of preferred stock, and I'm going to give her $6 every year. But here's the thing, Carlos took $5 of that $100 to pay for his summer home in the Hamptons and his expensive investment banker stuff. So I only got $95. So now I've got $95 in capital, but I'm still paying Danelle $6 every year. What now is my cost of capital? Before it was 6%. Now it is, you can tell me higher or lower. I would settle for that.
Can you tell me what's it?
I hear one vote for lower. That's good. I like that commitment.
Can you like repeat this once again?
Okay, so Danelle wants to invest in my company. She has $100. She gives it to her my investment banker, Carlos. He keeps 5 of it for his expenses because he knows people and knows the capital markets and does all that stuff. He gives me $95. So I got $95 of capital. And every year, I'm still paying her $6.
It's 11%.
11%? It's not quite 11%, but you're going to go with higher than 6%? It's so it's 6 divided by 95, right? Is my cost of capital. It used to be 6 divided by 100, which was 6%. Yeah, it's higher, so it's 6.32. All right, so because I had to pay that flotation cost to Carlos, get him some more fancy cars for his investment banker lifestyle, I'm paying a higher rate. That's one little kink we need to be aware of. The second is, suppose after Danelle buys this $100 preferred stock in my company, things change in the company. My company becomes more risky, less risky, and she starts passing that note around, and that note becomes worth, say, more than $100. And then I go back to Carlos, or Carlos comes to me and says, you know what, the value of your company has gone up, or the strength of your company has gone up is a better way to say that. You could sell that same, we could just print out some more of those $100 shares, but now Frida is going to pay $116 for it. So I get $116 from Frida. I still only pay her $6, and I'm now paying a slightly lower cost of capital because my company is stronger. So now it's a $6 over 116 or so. Okay, let me show you the formula, which incorporates all of that. Cost of our preferred stock. Cost of preferred stock is going to be our dividend per share. In our example, it was $6. the price per share of this preferred stock, in our example, was $100, times 1 minus the flotation cost. In our example, it was 5%. So this is the second big piece of our weighted average cost of capital that we're going to cover tonight. Yep. Cost of preferred stock, dividend per share, price per share, flotation costs. Let's do an example. Suppose this price per share of preferred stock has gone up from when it was initially issued. It is now $116.95. We have set a precedent of paying 10% of the par value of that $100. 10% of the par value of $100 is our dividend, and we would never want to. We might, but we would dislike intensely deviating from that 10% because the market would get freaked out. Our investors would say, what is going on? And suppose our flotation costs we need to pay every time we run an issue of this is 5%. We're going to use this formula. What goes here? This is actually dividend per share. You're on the right track, Sharmista. 6 from my last example, but in this example it's a little different. You know what, I'm gonna stop you. I see where you're going, but it's 10% is our precedent of the par value of $100 is what the expectation we've set up for that dividend per share. So dividend per share is going to be 10. Price per share is going to be how much?
165.
Exactly, $160.95. That's how much money we could get, but we have to pay Carlos flotation costs of 5%. So 10 times 100, 160.95 times 1 minus 5 is going to give us a cost of preferred stock 9%. And that should be, I think that's all written out on your slides, right? Yeah. Or it's not? Solving part? Yeah, I wanted to give you at least one solid example written down where I give you something to work out yourself. Any questions on this? So this is step 2 of 3 of our weighted average cost of capital. We're rocking and rolling here. A couple of notes on preferred stock, apparently. And I never really worked in the capital markets like this, but your textbook says flotation costs for preferred stock apparently high. So we need to reflect those. Dividends, of course, are not tax deductible. We've been talking about that at the beginning of class. No tax adjustment. And that brings us to our third pillar of the weighted average cost of capital, which is the cost of equity. Quick comment on how we might raise equity funds. We could go to the capital markets and say, we need $50 million of new equity, so we're going to issue stock, and we're going to try to get players in the capital markets to give us that money. And we will have a return that those investors expect. They will, based on something like the capital asset pricing model, say, well, you're a risky company, we need a return of 11%, and if you don't produce that, eventually, we're going to have a shareholders meeting, and we're going to throw you out, and we're going to put a lot of pressure on you, and this, that, and the other thing. So that's one way we could get this $50 million of cash to fund the project. Now, another way we could get cash to fund various projects is we could just use profits from previous years. Profit from last year, you may remember from accounting, goes into an account called retained earnings. And we could just say, what if we take money out of retained earnings? And sometimes people think that you can take money out of retained earnings and you won't have the same demands on you. You won't have to meet that required return for that money because it's already there. It's just kind of sitting in a bank account. But that is not true. The market and your investors will expect you to meet a return the same way as if they had issued new stock. Does anyone want to explain why? So, this money in this retained earnings, this profits from previous years, as managers, it's not our money. It belongs to the owners. And the owners either want it back, or they want us to see something, they want us to do something efficient with it. They want us to use that money to put it into our business and make their required rate of return. Does that make sense? I think the comment was made last class or another class that sometimes it's a bad thing if a company has too much cash. This is an example of not it's a bad thing if you have too much cash, but just if you have a lot of cash sitting around, that doesn't mean you can spend it on projects that aren't going to earn you an effective return. That belongs to the owners. Question?
So, Professor, a large company like IBM has like millions of shares. So, what happens to all the retained money? It goes to the owners, or like?
Well, management will decide. Management will say, we've got so much in retained earnings, we don't have any projects that are worthwhile, we're going to give it back to the owners. And the owners might like that.
I mean, I have one more question. Owners are like major shareholders?
Everybody who owns stock. You know, the major shareholders will have more of a say because they have voting rights in the company and management has to listen to them more than someone who owns 1 or 2 shares. But everyone is an owner of the company if they have stock, if they have any piece of stock. So those retained earnings, they could go back to the owners. They could also be used in projects that are related to that company. IBM might say, it's time for us to get into because they don't really do smartphones at all, do they? Yeah, it's time for us to get into the smartphone industry. Apple's getting ready to stumble. There's some things going on and our technology is right. Let's do it. Let's take that retained earnings and let's pour it into some other new business. And the owners might like that as well. But if they do that, the owners are going to evaluate that based on the cost of equity capital. The management, if they come back and say, well, we only earned 4% on that money in this new line of business we got into, but it's okay because it was just cash sitting there anyway. Well, it's not okay because it was just cash sitting there anyway and you didn't have anything good to do with it. You should have given it back to us. And if you did something with it, then we're going to require that cost of capital. Does that make sense? Okay. Companies may issue new shares, common stock, there they reinvest retained earnings. Why is there a cost for retained earnings? We just talked about this. Earnings can be reinvested, paid out as dividends. Investors could use the dividends to buy other securities or do other stuff with that money. So there's an opportunity cost. You don't really need to worry too much about this term, but it's just a fun term to know, important in finance. The opportunity cost, the return shareholders could have earned on an alternative investment of equal risk. So that money sitting in a big bank account in IBM, there's an opportunity cost. It's the opportunity the investors, the shareholders are missing out on by not having that money. 3 ways to determine cost of equity. We already have one, which is what? CAPM, capital asset pricing model. Thank you. Lifesaver. Not that whole last week, it's been just a bad dream. All right, we've got CAPM. We've gone through the pain in learning that. I feel like you all have a good general sense of it. Capital asset pricing model is one way we can determine the cost of equity. Another way, we can do what's called a discounted cash flow. And I want to introduce this for a couple of reasons. This may look similar to the preferred stock formula, where we had dividend divided by the price, factored with the flotation costs. except we've got this plus G. And that's the reason why I want to expose you to this formula, is because this G is an important part of finance. You need to have some familiarity with. It's the growth. In addition to a dividend that you might be paying, the investors want this stock to appreciate in value. They want it to grow. So the required return on stock is going to be higher because of this growth figure. Third way, which I just want to mention to you now, we won't do any calculations for, the company's bond yield plus a judgmental risk premium. So the amount they pay on bonds for debt plus a little bit more. Now why, we talked about this a little bit earlier, why would a return on equity be necessarily higher than a return on debt? Why would a company have to pay more for equity than they pay more for debt? Remember we talked about what happens in bankruptcy? Yeah, so who's in line if this company goes bankrupt? Who's in line to get their money back based on the assets that a company still has? How does that line work? We've got debt holders, equity holders, preferred. So who's first in line? What did you say, Dino? They're not first in line. Close. Who's first in line? Debt holders. Debt holders are first in line. So debt holders are going to demand a lower return. And second in line to them? Preferred. So they're going to demand a little bit higher, but not quite as high as equity holders, who are last in line. Equity holders get screwed if the company goes down. So let's talk about these first two. Do a couple of examples after we talk about flotation costs. Now, flotation costs for equity, sometimes they can be very high, but it only happens once. When a company issues stock or does an initial public offering, the amount that the investment bankers take from that is apparently very high. But after that happens, those shares are traded on the secondary market, and we don't calculate flotation costs every time there's a new person who owns a piece of our company. So sometimes for equity issues, they can be very high, but we'll pretty much ignore them because they only happen infrequently. They happen infrequently. That's what that says. So let's do an example with our capital asset pricing model. We're assuming we've got a risk-free rate of 5.6%. The risk premium in the market is 6%. The beta of our company is 1.2%. We're going to take that information and we're going to determine what is the cost of equity capital, the discount rate. Use our capital asset pricing model formula. Let's see, what do we put here in RF? Risk-free rate. So this is the required return. There are no 5.6, absolutely. And what is the risk premium in the market? 6%. And what's the beta? Outstanding. Crank that out. It's going to give us a cost of capital 12.8%. Make sense? Fantastic. A couple issues we want to note using the capital asset pricing model. How do we determine that risk-free rate? Apparently, analysts use long-term rates, 10 to 20 years, government bonds. So not only risk-free in our minds, government bonds, but long-term government bonds, 10 to 20 years. What's the basic rate, the standard rate on those instruments? Most analysts apparently use a 3.5 to 6% rate for the market risk premium. There are various online resources you can look at which will give you an estimate for the risk premium in the market. Yahoo Finance, Value Line. Does anyone use any of those services on a regular basis? I'm sure Bloomberg would have estimates. Sometimes those estimates can be noisy. We need to keep in mind that it's just an estimate. Capital asset pricing model is important, pretty much all we have, but they are estimates when it comes down to the end, when it comes to the end of the day. Let's look at the second way we can determine a cost of equity capital. Remember I said there were three ways. The first is CAPM. The second is this discounted cash flow model, which I'm going to introduce this aspect of growth. And the third was the bond yield plus a little bit. We're not going to worry about calculating that. We're just going to make a mental note that bond yields are lower than cost of capital, cost of equity capital. So suppose we've got a dividend this year of $3.26. We've got a price of our stock at $50. Flotation costs are zero because the IPO happened years ago. We don't have to pay those over and over again. And we've got an expected growth rate of 5.8%. So our investors are expecting our company to appreciate in value at least that much, grow that much. The formula for the cost of equity capital is going to be the dividend. See this little D1? It's not D0, it's D1. So the dividend next year. So an investor invests, they're not getting the dividend this year. They're going to get a dividend next year, and they're going to expect a certain growth rate. But the price is P0 is the amount the investor pays at time zero. Factor in for any flotation costs, and then we add the growth rate. So what do we put in this D1? How do we figure that out? What goes there? I'll give you a hint. It has something to do with this D0 and this G figure. So, no real reason you should know the answer to this because we haven't gone into it.
D0 is the dividend for this year.
Yes.
D1 is for the next year.
Yes.
So there are two dividends.
Was one dividend every year?
One dividend every year, but so we have to add one more dividend over here.
All right. Well, the answer I'm looking for, and again, I didn't really expect you to know this. I was just asking you if anyone wanted to guess. The answer I'm looking for is we factor a growth rate of 5.8% into the dividend this year. So we multiply 3.26, times 1 plus 5.8%. Yeah, so it'd be 1.058 times 3.26. Dividend this year plus the growth rate, price. The price is just going to be the price at time zero that we receive. Flotation costs we said were zero. Growth rate here is 5.8%. Crank that out. There's a misprint on my slides. Sorry about that. This should say 3.26. But let's figure out if, even though I made a misprint here, did I do the calculations correctly? See what I'm talking about? This should be 3.26 times 1.058 divided by 50. I do not have my calculator. So let's crank that out. Let's see what happens when we put in the proper numbers. This should be 3.26. This should be 1.058, which it is. This is 50, which it is. 1 minus 0 plus 0.0058. Tell me what you get. Do you get the 12.4%? Or do you get
12.7?
All right, we've got one vote for 12.7. That makes sense because it should be a little bit higher.
12.7.
All right, we got 2 votes for 12.7. Can we get one more?
13.
All right, 13.
I mean, 13.3%.
Okay. Are you confident on that? You want to try it again? Oh, you tried it twice? Okay, like I said, I do
I'm
not.
sorry. 3.26, not 3.56.
You got 12 point what? What'd you get? Okay. Did you make this change? This should be 3.26. Yeah, change it. So, what do you got to know?
I was the same thing, but I did 3.12.
Okay. Okay. Yeah. Sorry about that. This is a legitimate mistake. I apologize, but I think it could be an important learning opportunity. We get to actually practice this rather than blindly assume that your professor got it right. Okay, I think 12.7. We're comfortable with that. All right. We got 3 votes for 12.7. No one disagrees. So go ahead and scratch out that 12.4. Put 12.7. Scratch out this 3.12 because it should be 3.26. Now we know how to use the discounted cash flow formula for estimating the cost of equity. Let's go ahead and talk for a minute about this growth rate, how we might determine a growth rate. We could use historical growth rate. We could look at the past 5 or 6 years of financial statements and say sales have grown by 4.9% over the last 5 years, averaged out. That's the growth rate we're going to use. You could use one of those online services I mentioned, Value Line, Yahoo Finance, Zax. This is not my service. This is another service, though. Or you could use an earnings retention model, which we will talk about briefly. Learn how to do a quick calculation. Earnings retention model. Suppose a company has been earning 15% on equity, ROE 15%, and been paying out 62% of its earnings in dividends. So let me paint this picture a little differently. So we've got a company that has millions of dollars. It takes the equity investment and the return on equity when we calculate it in the financial statements, like we learned a few classes ago, is 15%. Suppose that company doesn't pay out anything in dividends. That company takes that 15%, buys more factories, buys more inventory, wines and dines some clients, pours it all back into the company. How much would we expect that company to grow in following years? So it had 15% return on equity. That's how much was, maybe it had $100 million in equity investment, and the returns based on the income was whatever 15% of 100, so 115 million. That 15 million, or all that excess, was invested back into the company. All right, the answer I'm looking for is we might expect a growth rate of 15%. So if this is the return on equity, and all that money is poured back into the company, then we might reasonably expect that following year there would be a growth rate of 15%. That's how much the return is on the equity investment. All of that money gets poured back into the company. You might expect 15%. Now suppose we have a return on equity of 15%, but we pay out half of that in dividends. We pay out 50% of our earnings to our equity investors, and 50% we pour back into the company, buy factories, do stuff with that money to improve the business. If that were the case, how much might we expect the growth rate in the following year to be? 7.5. That makes sense? So, how about if we're paying out 62% of our earnings in dividends, and the remainder, 38%, is going back into the company? In that case, how much would we expect the growth rate in future years to be?
30% of the 15.
Yeah. Yeah.
Thousand or million.
That's right. 38% times 15%, which would be, what's that? 6.9 something. In fact, I think I may even have calculated that one out.
5.7.
Yes, you got it. So that is an earnings retention model to help us calculate an expected growth rate. Any questions on that? Let's see what else we got. I think we're ready to put this all together. We have 3 pillars. We have the cost of debt, we have the cost of preferred stock, we have the cost of common equity. We're ready to put this together for WACC. Before we jump into that calculation, though, we need to determine weights. Percentages of the firm that will be financed by each component. So we're a $100 million firm. Those are our assets. We got 30%, $30 million in loans from Bank of America. We've got 20% in preferred stock. We went out to the capital markets and said to these preferred stockholders, we'll probably pay you a dividend all the time and you'll be second in line if something goes bad. Here, give us money. All right, here's your certificate that says preferred stock owner. That's 20% of our money. And then suppose 50% is common equity. Went to the investment banker years and years ago when we did the initial IPO, and we said, look at us, we're an awesome company. We're going to grow in value. We're going to appreciate, and we're going to make you a lot of money if you hold us long term. So, say we have 30% in debt, 20% preferred stock, 50% in equity. We're going to take those weights and multiply them by the costs of each of those types of equity. So, weights are percentages of the firm that we finance with each component. If possible, we use the target weights. So, target weights might be different than the actual weights, because suppose the market value of stock fluctuates because we're in the middle of a recession or the market's volatile. So that $50 million in the example I just used, if the market's up, that could be a lot more than 50%. If the market's really down, that could be a lot less than 50%. But we use target rates because that's the way the company wants to operate over the long term. The company wants to make a consistent return to its debt holders, which should be about 30%. Preferred stockholders, which should be about whatever the target rate was. Equity holders, which should be whatever that target was. So we'll use our target rates if given. If we don't have those, we can use market rates. If you don't know the targets, use the current market values rather than current book value. So everyone knows the difference between the market value and book value. So use the market value if we've got it. Use the book value by looking on the asset, balance sheet and financial statements if we don't even have that. All right, let's look at an example. Suppose we have a company with a stock price of $50. We have 3 million shares outstanding. The firm has 25 million of preferred stock, 75 million of debt. We want to calculate the weights of these 3 types of capital. We know with our $50 million or 50 million shares, each, $50 per share, 3 million shares outstanding. So, fine, whatever, $50. I'm just concerned about where that dollar sign is, doesn't really matter. Whatever. So 50 million times 50 times 3 million, it gives us 150 million is the weight of our stock. Preferred shares, we know we've got 25 million. Debt, we've got 50 million. What's the total value of our company? 150 million. Yes. And just give me an eyeball then. So, all right, did you say 150? 250. Okay, so 250 million. So is the total value. We know we've got about 150 million. We've got 150 million in stock, so we know that's going to be maybe in the 60% range, something like that. Let's calculate each of them. Let me throw these out here. The weight of our company in stock, 150 divided by 200 gives us 60%. Preferred stock calculates out to be 10%. Debt, turns out we're a 30% weighted debt company. Make sense? What we're going to do next, we're going to take that 6%, that 10%, that 3%, respectively, and multiply it by the cost of capital for each component, and crunch those all together into one number. Before we do that, we've got this paragraph note. Target weights for this company are the same, I went over that a minute ago. The target weights for this company are the same as the market weights, but sometimes market weights can fluctuate, and we want to use target weights if possible. So this is the WACC, weighted average cost of capital. Take a look, absorb it for a minute. So the weight of the debt, which we calculated out, I believe it's 60% or I forget, 30%. Cost of the debt. Remember, there's a tax advantage for the debt, so we multiply this cost of debt times 1 minus the tax rate. The weight of the preferred stock, how much preferred stock we are financed with, times the cost of preferred stock, plus the weight of our common stock times the cost of our common stock. Weighted average. All right, doesn't look scary so far, does it? So let's throw in those numbers. Calculated throughout class. We know we've got 30% in debt. We know that our before cost, if you cast your mind back to the first calculation we did with the before cost, after tax cost of debt. Before tax is 10%. We know tax is 40%. We know that we have 10% in preferred stock. We know that cost of preferred stock is 9%. We know we have 60% in common equity. We know the cost of common equity is 12.8%. So crank that out. We're going to come up with a weighted average cost of capital, 10.4%. So what do you think? You've calculated weighted average cost of capital. Any questions on that at all? So just have a few notes on that, and then a few examples. Yeah, go ahead. This 30%, 10%, and 60%. Oh yeah, the 10% was. This is the before cost tax before tax cost of debt, and that's back, the 6th or 7th slide.
Yeah. Okay.
And this 9%. Yeah, did we calculate that preferred? That what we did with preferred stock?
I don't think we did the preferred, but I see
Let's see. We have. Yeah, slide 14. We got the 9% cost of preferred stock. Good. I'm glad you asked about this because this is how we put it all together. You have that frame of reference in your mind. This is exactly what you can do in your homework and on the quiz when you become a rich investment banker yourself. Okay, any questions on this? Couple of notes. There are factors that determine the cost, the weighted average cost of capital, or that determine weighted average cost of capital. Certain factors that are uncontrollable from a management standpoint, market conditions, interest rates, what's the market risk appetite, what are the tax rates. Those are things management can't control, but there are things management can control, and they do. They try to. They may want to keep their cost of capital as low as possible so they don't have their investors breathing down their necks. Capital structure. They could have more debt and less common equity. Based on what we've seen so far, that would lower the cost of capital, right? Because debt is usually lower than equity. Now, there's some dangers. They don't want to do too much. Because if they have so much to pay in interest, then they might go bankrupt. Like Donald Trump, Atlantic City, Taj Mahal, paying 13%, I think, on bonds because it was so highly levered. So that can be a dangerous strategy. Dividend policy. We can change our dividend policy, which should change our cost of capital. We want to do that very carefully for similar reasons. We don't want them, or not similar reasons, but investor confidence reasons. We don't want our investors to freak out if we make too many changes too quickly. And investment policy. If we're investing in really risky projects, investors are going to say, gosh, I want a higher return. Either that or invest in safer projects. All right. So I've got a couple examples to allow us to work this out. This is a capital asset pricing model. We'll use that for the WACC, and we will assume that there are no preferred stock owners in this company. And this is very common. Commonly, you will just see cost of debt with the tax adjustment plus the cost of capital plus the cost of equity capital. In this particular example, we're going to say we have a target debt ratio of 10%, which leaves us 90% for equity. Our cost of debt in this case is 12%. Risk-free rate is 5.6%. Tax rate 40%. Beta of our company, we may be engaged in some pretty risky stuff. So we have a pretty high beta of 1.7. Market risk premium of 6%. So let's calculate it out. Our cost of capital, we're going to start with cost of equity. And we're going to use our capital asset pricing model. And I think I left this one blank for us to work out together. So let's start with that. Let's have you all calculate out cost of equity in this example. answer for us. What do you got, Janelle? Oh, so Frida, what do you got? This is someone I'm gonna walk. Do you want me to do you want to continue working for a few minutes? Or you want me to walk you through it? Yeah, I'll keep it. Keep it. Take it. All right, let me step a step. You ready? 6.28? No, not quite. Let me walk you through here. So we're trying to determine the cost of equity. What is our risk-free rate?
5.6.
Very good. And what is our market premium? Is it 6%? Yeah, that sounds right. And what's our beta? 1.7. Yeah, we just cranked that out. We get 5.6 plus 6% times 1.7 equals 15.8. Were you all overthinking it? Oh, you were trying to do the whack without this?
No, the market minus the risk-free. Wasn't that 6% minus 5.6?
That's the risk. So this is the risk premium. So the premium over and above the risk-free rate. Sorry if that symbolism threw you off. So the risk in the market over and above what the risk-free rate is.
So the 6% is RPM.
Yeah. Yeah. Okay. Well, we haven't had too many intellectual challenges tonight, so hopefully that'll just be something to put it all in context for you. So let's go back. We know our target debt ratio is 10%, so that means 90% is cost of equity. Our cost of debt is 12%. Before cost of debt is 12%. And we knew all this stuff, which we used to calculate the cost of equity. And now we're going to put that together with the weighted average cost of capital. So what's our weight of debt? I'll give you just 2 minutes. I don't want you to spin your wheels too much on it. Just look at this for a minute. I'm going to go through and ask you what are each of these. Just orient yourself. All right, what's this? WD, weight of debt. What is it? What's our target debt ratio? So WD is 10%. Excellent. Cost of debt, RD, cost of debt, 12%. Yeah, that's pretty high, right? Yeah, so we must be doing some risky casino type stuff. Tax rate, I think we said 40%. Weight of stock, weight of equity, 90. Outstanding. Cost of stock, cost of equity. Yep. Previous example, we calculated at 15.8. We're going to crunch that all together. Take a couple minutes. Do that. Sometimes it can be confusing with the calculator, the plus and the multiply. It's just something you need to be fluent with. Go ahead and practice it now on a non-threatening situation where we know we're going to get the answer right away. All right, 14.9. How do y'all like that? How do you like me now? 14.9. Any questions on that calculation? We're going to finish up with a quick example of using the discounted cash flow method to determine the cost of equity. And that allows us to consider a couple things. One, it allowed us to get familiar with this idea of growth. This letter G, you should understand fluently if you're going to work in finance. And two, it allows for a calculation of flotation costs. So just suppose we have to pay the underwriter a lot for this initial public offering. And another thing that might come into play that I didn't talk about is if you issue new stock, it might be a negative signal to the market. Does anyone know why that might be?
Companies are looking for investment.
Yeah, so you're looking for investment. Why is that bad, though?
I think companies going down.
That's the reason they need money. Okay. All right, so the company's going down, so I need you to help me.
That's what I think.
So when somebody asks you for money, you assume they're in trouble. All right. Well, I could. Why do you need the money in the first place? Should you just use last year's profits?
It's not because that. It's looking for a new project or something.
Yeah. So it could be looking for a new project and say we're expanding. We're in the best position to start getting into smartphones. So we need more money, and you should be on the front end of this investment because we're going to grow like crazy. So it could be positive, but it's often a negative signal. One reason is that if management thinks the stock price is high, that's when they would issue new shares. They look at the market and say, wow, our stock price is up to 160. It's only worth 120. So let's sell some more at 160. So managers have inside information. So when they start selling stock, the company might say, they're selling stock because they think it's high. And there also might be other issues. They're just asking for money. This could be a problem. Maybe they're trying to hide the fact that they just need the money to pay off something else. That could be an issue. So those two things, paying the investment banker the flotation costs or the negative signal, could be something we could use to factor into that flotation cost. So that's a reason why we might want to use this discounted cash flow metric for determining the cost of equity. Let's do a quick example. Price of each share that we're going to issue is $50. Dividend we paid this year, $3.12. Growth, 5.8. Flotation costs are now 15%. This is a very expensive IPO, or maybe the cost of this stock, when the investors here were asking for more money, is going to take a bit of a hit. All right, excellent. You all are working diligently and practicing that. So let's do this together. What goes here? This D0, 3.12, and we want to grow that to consider the dividend we're going to have to pay a year from now. So 1 plus G is 1 plus 5.8%. What goes here? The P0, 50 outstanding, and the flotation cost is how much? And the expected growth is how much? Outstanding. I did 13.6%. Excellent. Great. Any questions at all on that? All right. We've got some time to do what we always do at the end of class. We can go over the quiz that was due for today. We can go over any of the homework that was due for today, or any of the homework that was from last week. There might be some interest in going over those quiz questions. Some of the true-false I know were a little bit tricky, but I thought they were a good way to ingrain the intuition of the capital asset pricing model. Want to do that? Go over the quiz? Yeah? Alright. If you're comfortable, you feel you need to leave, then that's no problem, but I'll take a look. I'll open up the quiz and go over some of those questions, and then we can go over any of the homework that you might have had questions about. Chapter 6, right?
Yes.
All right. Take a look at this first one. Actually, maybe we can. It's a surprise. All right. According to the capital asset pricing model, investors are primarily concerned with portfolio risk, not the risk of individual stocks held in isolation. Thus, the relevant risk of a stock is the stock's contribution to the riskiness of a well-diversified portfolio. Who can explain to us why that's true?
I know according to the cat model, isn't it that they say like that I guess you could say the risk in one stock kind of helps
Yeah, the risk of one stock, even though it's crazy volatile, may balance out another stock. So we don't penalize that stock necessarily for having a crazy amount of risk. What we do is consider how much risk that stock adds to a well-diversified portfolio. Risk-averse investors require higher rates of return on investments whose returns are likely uncertain, and most investors are risk-averse. So, risk-averse investors want a higher rate of return if something is more risky. We looked at that bell graph, and there was one that was thicker, which had a higher chance of extreme gains or extreme losses. And we said we don't like that as much as we like the taller, thin one, which will give us a more consistent return, and thus we will demand less of a return for that. Diversification. Diversification will normally reduce the risk of portfolio of stocks. Yeah, so as long as the correlation between the stock that you're adding and that portfolio is not a perfect one, if it's anything other than a perfect one, it will reduce the riskiness of the portfolio. Market risk refers to the tendency of a stock to move with the general stock market. A stock with an above average market risk will tend to be more volatile than an average stock, and its beta will be greater than 1.
I have a question.
Yes?
Why the beta will be greater than 1?
Because if the beta is 1, then it has the same amount of risk as the market itself. And if the beta is higher than 1, then it will have a little bit more risk. Remember how we calculate beta is the correlation between the market and
The standard deviation. The individual divided by.
and the individual standard deviation. So we consider a beta of 1 to be consistent with the market. That make sense? Beta of 1 to be representative of the market. Market risk refers to the tendency of a stock to move with the general stock market. Stock with above average risk will tend to be more volatile than the average stock. And its beta will be greater than 1. Are you confused still? I'm a little confused trying to explain it. Because, are you thinking because does it have to do with the correlation coefficient and relative risk of the individual stock and the market?
I missed this one because according to the formula about the beta, I tried to some ways that you can make sure that the beta is going to greater than 1.
You can't make sure what?
The beta is greater than 1. I mean, according to the formula that you
Okay.
give me.
Yes.
Sometimes it's gonna be
So let's look at it this way. Let's say that the correlation is 1.
Yep.
Right, so the correlation between the individual stock and the market is 1. So now to calculate beta, we need this 1 times the standard deviation
individual.
of the individual divided by standard deviation of the market.
Yep.
So, if this is more volatile than the market, then this is going to be greater than
Yeah.
1. If it's less volatile, then it's going to be less than 1.
But the problem is, how can you say the correlation is 1? I mean, you just assume that, or
For the quiz question, we do not assume that, but let's do a thought experiment.
what
So,
is? Yeah.
so suppose it is negative. Suppose it's 0.5. We'll
Yeah.
say beta is 0.5. Or rho is 0.5. Correlation coefficient equals 0.5. Alright, so that means our beta is going to equal 0.5 times over the market. So, if this were so what would this have to be for this to be 1? Let's figure that out. So if this were 2, so if this were twice as volatile than the market, so this would be 2 over 1. Alright, so that would mean the beta
1.
is equal to 1. Alright, so here we have a beta of 1, and we have a stock that is individually more risky, twice as more risky as the market, but they're only correlated by 0.5. So let's go back to the question then. Market risk refers to the tendency of a stock to move with the general stock market. A stock with above average market risk will be more volatile than the average stock, and its beta will be greater than 1. All right, helps out, Charminsta. I don't know. I'm a little confused by this question. It may have. Let me think about this. Let me think about this one and get back to you. It may have to do with the. Remember we talked about the weight, like the weight times the beta times the whatever can tell us how much risk we're contributing to that portfolio.
So that beta of 1 is not like the average?
We say beta of 1 is average. Yeah, like the average for the market portfolio. Yes.
So with that question that you just asked, yeah, so the way I assumed that answer was, that I got the answer right, was that if that's the average 1, and you're saying that it's more volatile, then it would be over.
Yes. Yes. Yes.
That's where
And that's what we came up with. If we're assuming the beta is 1, but then Jing and I were just going through a thought experiment where, well, what if the beta was 0.5? You could have a more, or maybe it was less. It could be less than 0.5.
Yeah.
It could be like 0.3, and you could have a stock that's individually more volatile than the actual stock, and then it would be less than 1. And you look at that and say, all right, so it's less than 1. And you know why it's less than 1? I got it. It's less than 1 because the volatility of this stock cancels out the volatility in the portfolio.
So it's not gonna happen.
So the amount of risk it's contributing to the portfolio is lower. I think it has something to do with that. Let me think of a better way to explain that between now and next week. But I think that's what's going on there. Because it's risky, we don't penalize the stock because it's risky. We actually might reward this stock because it contributes less overall risk. Okay, so let me read number 5. Any change in its beta is likely to affect the required rate of return of a stock, which implies that a change in beta will likely have an impact on the stock's price, other things held consistent. Is that true or false? While we're waiting for the projector to come back up. Any change in beta is likely to affect the required rate of return on a stock. That part is definitely true. Which implies that a change in beta will have an impact on a stock's price. Now, what is price? It's another word we've been using for price. At the beginning of every class, I show you that graph. It starts with V. Value. And we calculate value based on the cash flows and based on the discount rate we use. And if we use a higher discount rate, the value goes down. And value going down, price going down. That is true because any change in beta will impact the stock's price. Make sense? One key conclusion of the capital asset pricing model is that the value of an asset should be measured by considering both the risk and the expected return of an asset. Assuming that the asset is held in a well-diversified portfolio, the risk of the asset held in isolation is not relevant under CAPM. How about this last sentence? The risk of the asset held in isolation is not relevant under CAPM. That's true. It matters how these assets work together. And does that keep us? Yep. Assuming it's held in a well-diversified portfolio. All right, so we're good there, right? Risk aversion implies that investors require higher expected returns on risky investments than on less risky securities. So we don't like risk. So if there's a lot of volatility, we want a higher return for investing. That's true. The stock's beta measures its diversifiable risk relative to the diversifiable risks of other firms. Now, that is not true, as you can see from the green arrow. But why is it not true? What little word could we change to make it true?
Relative to the market?
Absolutely. Beta scales everything to the market. Did anyone get that one wrong and is mad because they think firms represent the market? All right. I feel you. I feel your pain. If that's the difference between grades, then we'll talk at the end of the quarter. Even if the correlation between the returns on two securities is +1, if the securities are combined in the correct proportions, the resulting two-asset portfolio will have less risk than either security held alone. All right, now the thing that makes this statement false is the first sentence, the first part of the sentence. even if the correlation between two returns on two securities, even if the correlation between the returns on two securities is +1, if the correlation is +1, then we cannot lower the risk of that security by combining them because they're identical in their response to movements in the market. We need two securities that have a correlation of less than 1 to decrease risk. The y-axis intercept of the security market line represents the required return of a portfolio with a beta of 0, which is the risk-free rate. It's that line we were using 4%. Okay, we got to do some work here. Ouch. All right, you're considering investing in one of these three stocks. Stock A, B, C has these standard deviations and has this beta. If you are a strict risk minimizer, you would choose stock blank if it is to be held in isolation, and stock blank if it's to be held as a part of a well-diversified portfolio. Who can explain this one to us?
If you only care about the risk of the one stock, you care about the standard deviation only.
Mm-hmm.
And we said that less deviation is less risk.
Yes.
So that would be your 10% of stock B.
Fantastic.
But if you put it in a portfolio, then you actually care about the lower beta. Lower than 1, and the lowest of them all is stock A.
Absolutely.
Which is 0.5. So it's B and A.
Sound good? Any questions? Which of the following is most likely to occur if you add randomly selected stocks to your portfolio, which currently consists of 3 average stocks? The expected return of your portfolio is likely to decline. Why is that not likely to occur? The reason why that's not the answer is because the return is a weighted average. And the new stocks you add could be higher, could be lower. You have no idea. It's just going to be whatever the weighted average of the return is, not necessarily going to decrease. The diversifiable risk will remain the same. So diversifiable means risk that can be diversified away because of weird little eccentricities because of different companies. But the market risk, which is the risk that firms face because they're in this same market together, will decline. That is not the answer. Can someone tell me why? Now the market risk, okay, so the second part of the sentence is true. The market risk will likely decline. As you add more, no it won't. Never mind, sorry. The diversifiable risk will remain the same. That's wrong. Because as you add more and more stocks, if you only have a portfolio of 3 stocks, then you're getting a more diversified portfolio. Right now you're just sitting with 3 stocks. What if the CEO of one of those companies dies in a plane crash? That's 1/3 of your portfolio. The company is in turmoil. Whereas if you have 40 stocks, one CEO dies in a plane crash, the other comes up with a master invention. Both the diversifiable risk and the market risk of your portfolio are likely to decline. That is not true, because the market risk does not decline. There's a certain amount of risk we must bear because we're in the market. Recession hits, it's going to hit one company just like it's going to hit another company. There's a certain amount of risk which cannot be eliminated, and we'll call that the market risk. So that one is not true. The total risk of your portfolio should decline, and as a result, the expected rate of return of your portfolio should also decline. So the total risk of your portfolio should decline. That is true. But the beauty of this that we discovered last time is your expected return does not necessarily decline. It's just a weighted average. And then the answer of course, is the diversifiable risk of your portfolio will decline. The risk that can be diversified away, market risk, will stay the same. Any questions? All right, Zacher Company, again, this is not my company, has a beta of 1.4, risk-free rate of 4.25, market risk premium of 5.5. What is the firm's required rate of return? Do we want to crank this one out? Yeah? Okay. Do it over. Let's see if I can do it over here. I won't have to turn off the. All right. So we want the cost of the individual investment. And what's the formula we're going to use? We're going to start with the risk-free rate, which is how much? Does anyone want cookies? Cookies? I'm on a diet. What's the risk-free rate?
4.25.
4.25 plus, what's next? 430, is that? 430? 4.25, yes. And so we need the risk premium for the market, and we need data.
5.5 minus.
No, times 1.4.
Yeah, that was 1.4. All right, so yeah, so sorry. I hope I don't give you emotional distress with the example we went through earlier, Carlos. Normally, it won't be tricky like that. You'll just say the market
for a
risk
second
premiums.
I thought it was. Yeah.
Yeah, you're thinking because I used too many symbols and words in that last example. So let's crank this together, and hopefully we get 11.95. All right, Megan Ross holds the following portfolio: A, B, C, D. There's a certain number of a certain amount of investments. There's the beta. What is the portfolio's beta? Now, we found that the beauty of beta is that it is scaled relative to the market. So once we can construct the beta of a portfolio, we can do a weighted average when we combine portfolios based on their betas. Now, before we put everything in the beta format, we found that we could not do a weighted average of standard deviation because, happily, we had that positive effect of one company's standard deviation having a positive interaction with the other, smoothing out our returns, which resulted in less risk and a weighted average return. But once we calculate the beta, we can just do a weighted average. So what do we first need to calculate? This is 150 out of 375. That's like, what's that? 35%? 40% times 1.4 plus 12% times 0.8 plus this, plus 100,000 divided by 375, that percent times 1, plus 75 divided by 375 times 1.2. Weighted average, once we have beta, fair game. Fisk Roofing Supplies has a stock beta of 1.23. Its required return is 11.75, and the risk-free rate is 4.3. What is the required rate of return on the market? Okay, so this is fun. They've given us pieces of this required return for equity, and they're asking us to back into the required return for the market. So, what do we know? Do we know this?
Yep.
RI, what is it? 11.75. So we know 11.75 equals, do we know the risk-free rate? Yes, 4.3. Plus,
1.2.
all right. So in and we're looking for the market risk premium.
That's the one.
Yeah, plus X times 1.23. So we've got a bunch of numbers and one unknown. Should be pretty easy. Whatever, subtract 4.3 from this side. Whatever that comes out to, we divide that by 1.3. And we should get an X equal to 10.36. Jing, I'm going to think about number 4 as I'm drifting off to sleep tonight. And way to explain that without being confusing.
Sorry.
So I'll be here if anyone has any individual questions or any more on this. We look forward to seeing you all next week.
Thank you.
Thank you, Carl. Yes.
You said that we repeat one of our quizzes,
Oh, yes,
right?
yes, yes, yes.
We can decide that by the end of the quarter?
Yeah, that'd be a good strategy. So you can actually
Like
and you
worse
can, yes.
than the current one, you know?
Yes,
I wanna
or
have-
you know, if Danelle comes up with a strategy for looking back on your quizzes, you could at the end of the quarter when you're preparing for the exam look back on everything. Whichever one you do worse, just take another shot at it, which should be easy.
But then
'cause
you would have
the
to,
actual
you would
answer.
have to
Just reset it.
reset.
So you'll send me an email.
I should say for later on. But I don't know. Good night. Good night.
Nine. Nanya, good work. Good work on the quizzes. Everything going okay?
I have to go long.
Oh, okay. You bet. Good luck. Well, let me know if I can help with anything. Sure. Absolutely. Okay. Night, Chairman.